we're 27 months away from the first hike. We're 11 months away from the last hike. Monetary policy has had a sufficient amount of time to work its way through the system. Inflation is just stuck at higher levels. And in my opinion, the next step will be a hike. We really have not been able to tighten financial conditions, no matter what the Fed says or does. And so I think they'll ultimately turn around and hike.
Hey everyone, this episode is brought to you by Avalanche. Everyone's favorite red coin is a fan of On the Margin, and we are a fan of Avalanche as well. Talked about it on the program before. Avalanche is a very cool solution. Their subnets allow for a very scalable blockchain that's also interoperable at the same time. And it's not just me. The institutions are noticing, and they're building on the evergreen subnets as well. You're going to be hearing all about some of those institutions later in the episode. For now, Avalanche, thanks for making this possible. Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions. You're going to be hearing all about them later in the show, but for now, Mantra, thanks for making this episode possible.
Welcome back to another episode of On the Margin, and joining me today is Danny Dayan from Montreal, Canada. How are you doing?
Hey Felix, how are you?
Doing well, thanks. Yeah, super excited to be chatting with you today.
Same here. Thank you for having me on the show.
Totally. Well, let's dive right into it. You've been making the bold call. That's quite the contra call these days, that you believe that the Fed is more likely to hike than cut in 2024. I'd love to understand why you believe that and just unpacking that analysis.
Sure. My view on inflation was a little less optimistic than everyone in the markets were at the end of last year. We did have some flattering data. It came at a period when we had exceptionally strong growth, 8% plus nominal GDP in Q3, and yet inflation didn't pick up. It, in fact, went lower. Everyone got really excited about that, including the Fed. And my view was that this was more of an anomaly than, the actual trend level of inflation, and that we were likely to get disappointments on this. And, that's how it started to play out this year. I looked at the most recent inflation report, and everybody, ironically looks at the nuances of these reports very, very closely. If expectation was 0.3 month over month core and we get 0.32, the market would have freaked out. If we get 0.29 or 0.28, the market celebrates. But that's just statistical noise, really. And, we're 27 months away from the first hike. We're 11 months away from the last hike. Monetary policy has had a sufficient amount of time to work its way through the system, even if you're a believer in the long lags and all that, which I'm not. I think the impact is much more immediate. But, even if you are a believer in that, inflation is just stuck at higher levels. 6 of the last 8 core prints have been 0.3 or higher. So it looks like anything below that is more of an anomaly than the normal. And that's a roughly 3.6% trend inflation rate. And, I knew coming into this year that both inflation and growth, or I had high conviction coming into this year, that both inflation and growth were going to be too hot for the, extraordinary amounts of rate cuts that were priced in. This was a high conviction view to just fade this. My perspective on the Fed was that their reaction function would slowly change. They don't go from extremely dovish to extremely hawkish or anything like that. They make moves in steps. And so they went from, at the end of Q3 last year, they were firmly in neutral mode. We can go more likely to hike than to do anything, to a firmly neutral mode at the end of Q3, to a dovish neutral, dovish hold or whatnot, and then very dovish, throughout their speeches to start the year. And now they've started to walk back the cuts. Now they're also saying, rate cuts are sort of optional here. And in my opinion, the next step will be a hike. And the reason why is that inflation, by the end of the year, we have very, very easy base effects. And it'll start to get a little uncomfortable if we're still printing these 0.3s every month. Base effects could push us over 4%. And so I think, given that this is year 4 of the inflation episode, the Fed's patience today will become impatience at the end of the year, in that expectations are starting to become embedded. There is really no stigma for workers to demand large wage hikes. Unions are asking 10% wage hikes. Job switchers are asking for much higher wages than when, job stayers Ultimately, we're seeing that, companies are saying, even if it means no volume sales, we'll increase prices if our inputs come in. So the psychology has changed, and it's consistent with a step up in inflation to what is just a little bit above the target. And so at the end of this year, I believe the Fed will look at this and say, it's still too high. We are not restrictive enough. I think they're slowly coming to this realization in their discussions about things like neutral rates and whatnot. I think the June FOMC meeting is almost as important as Jackson Hole 2022. So probably the most important macro event, since then. And the reason is that I think under any circumstances, inflation is maybe a little too sticky at a higher level, but it's not ramping up, like a second wave. Absent that, I don't expect them to do anything in this period before the election in either direction. Even if we had a little bit of weakness in the economy, I wouldn't expect them to cut either, to avoid, any sort of sense of political, dynamics in their decision making. And I think when it comes to the end of the year, they'll, like I said, they'll be a little bit more uncomfortable, which means that in June, they really need to try and control the message in this uncomfortable holding period till the end of the year, when they would finally be free to act. The biggest thing that I am noticing this year, which has surprised me, is we took out a lot of cuts from the pricing. We at our peak, we were about 8 cuts. We're about 1.5 cuts now. 10-year yield started the year at 370, made a move to 470, now is about 440. So rates have moved substantially higher, and yet we have not tightened financial conditions. There was a 2-week period where the S&P had a mini correction, which is something you would see every year. We really have not been able to tighten financial conditions, no matter what the Fed says or does. And so I think they've lost control of financial conditions. I think the dot plot in June is maybe their last attempt to regain control without hiking, because they do not want to hike. And when that, in my opinion, most likely will not work, that's what leads to them at the end of the year throwing in the towel and saying, this is not being solved. We need to deal with this. And so I think they'll ultimately turn around and hike.
So what do you think actually needs to happen? Because I understand the argument that we would need to see further hikes to tighten financial conditions, but I also see the other side of the argument that it feels like we've just been in this constant loop for the past 2 years, and it feels like we're missing something. Like, I understand if we add another 25 bips or so of hikes, that could, tighten things on a short-term basis, but it feels like at the first opportunity, we just reverse that entirely. What do you think is missing?
It tells you the economy's changed. It's been, one of my core views, what we call the financial conditions loop, right? Where, we might have tightening for a short period of time, and then you get this, the markets, the economy, whatever it is, rejects that tightening and then immediately goes into a much larger loosening. Most recent example was this whole period around payrolls, Fed, CPI, and the data was a little bit softer. And so the Fed, being dovish, which they always are, effectively allowed equities to bounce 6% in 2 weeks, 10-year yields to go down 40 basis points in 2 weeks, and the dollar to soften, a couple percent, 2 to 3% in that time period. And so whatever weakness or, softening in the economy we were having ends up being somewhat offset by these financial conditions episodes. The best way to think about this is go back to the last cycle. No matter what happened, there were so many little idiosyncratic risk events or dynamics that really, when you think about them in a big picture, not going to have a material impact on the US economy. The fact that Greece had out of control debt situation, that has like a negligible impact on the US economy, right? But equities would sell off in a risk-off event when these things were happening. China devalued their currency. Obviously, that was taken very badly by the markets. Swiss National Bank, allowed their currency to strengthen, taken badly by the markets. Taper tantrum, trade wars, almost anything that we had caused financial conditions to tighten. Didn't mean that it lasted long. It didn't mean that it turned into a bear market or anything like that. But this was something that the Fed was uncomfortable with last cycle, in that financial conditions were routinely too tight relative to what they were trying to achieve. And then this cycle is the complete opposite. They're almost always loose, and the default is loose. And it seems like no matter what we do, we can't tighten financial conditions. And I think that's what's necessary to achieve the slowdown that the Fed needs to accomplish their goals. And so I think there's a message here, and I think you brought that up perfectly well. There's a message here that, frankly, policy is not tight enough. And if policy is tight enough, you're not going to see this. You're not going to see a retail sales report print at zero, which is a bad sign for the consumer. Maybe it's just noise, but let's just say that it is a slowdown starting, and equities rally on that. In general, that would be bad for earnings. You would see equities come lower. You would see maybe companies start to say, if the consumer's weakening, maybe we need to rethink our hiring decisions. Maybe we need to rethink investment decisions. And that's how you get like a self-reinforced weakening in the economy that the Fed ultimately cuts rates, to respond to. But we don't see that, So I think that's a message that the Fed needs to be studying. It's very strange how they were very focused on financial conditions. And in the last few months, last 6 months or so, they're dismissive of the easing. They think financial conditions are tight. Nobody in the world really agrees with them on this. And it's just baffling that they've ignored this because it's really the issue they're facing.
Hey everyone, this episode is brought to you by Avalanche. Avalanche is a leading network of blockchain, which is giving access to some of the world's largest financial institutions to experiment and build on crypto rails. I'm a big fan of Avalanche. I've talked about it on this program before. The Subnet architecture leverages some of the best parts of IBC over in Cosmos, the interoperability protocol, and the rollups on Ethereum, with the result that if you're a financial institution, you can build on something that's highly interoperable, but also customizable and scalable. And it's not just me. Many of the largest institutions in the world are taking notice. And a couple examples of folks who are building on evergreen subnets include Onyx by JP Morgan's. They leveraged an evergreen subnet to explore how tokenization can revolutionize the asset and wealth management industry. Citi and the DTCC digital assets are testing private market tokenization on the Avalanche Spruce testnet with Wellington and Wisdom Tree. So again, some of the largest financial institutions in the entire world are building on Avalanche. Avalanche Evergreen provides a suite of institutional blockchain deployments, customizations, and tooling designed to address company-specific and industry-wide requirements for financial services. So join the institutional investors that are choosing Avalanche today. Go to avax.network/evergreen. Again, that's avax.network/evergreen and join the revolution. Avalanche, thanks very much for making this episode possible. Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions into Web3. So you guys have heard me talk about Larry Fink talking about tokenization. You've seen the clips on CNBC. You know that Larry and BlackRock are very, very excited about this idea. And the reason for that is they're looking at these trillions of dollars of off-chain real-world assets. They want to digitize those and bring them on-chain, which is going to be a massive opportunity. But in order to do that, they need a compliant L1, and that's where Mantra comes in. Mantra's been steadily climbing the ranks and now stands among the top 4 RWA projects on CoinGecko, which is representative of its rapid growth and influence in the tokenization space. Mantra's built using the Cosmos SDK, so they have some very cool stuff out of the box. They've got IBC interoperability. They also leverage CosmWasm smart contracts. Very cool design from an architectural standpoint. The next phase on the blockchain's testnet is Hongbai, so that's launching soon. So if you're a dApp developer or something like that, there's a lot of very cool opportunities for you, and I highly recommend that you click the link at the bottom of the show notes. That'll know that I sent you. Thanks very much again, Mantra, for making this possible. And again, guys, click the link at the bottom of the show notes.
So it seems like a lot of it comes down to how you measure restrictiveness. The Fed is definitely in the camp of what you mentioned earlier around R star, the natural interest rate. And for those that don't know, that's really the rate where policy is neither restrictive or accommodative. That's one way that the Fed really measures things. People also look at something like, real yields of just the nominal yield minus, basically a break-even rate or something like that. How do you measure restrictiveness, and how do you measure how loose we are? Are you looking at something like, say, where nominal rates are in relation to GDP, or what's your framework for that, measuring that conditions?
First of all, this is a great question. The Fed looks at, a variety of different things, like the Fed funds rate minus their supposed neutral rate. They look at the Fed funds rate minus inflation expectations, like you said, or versus actual inflation. And like you said, in all those measures, they think it's restrictive. I actually have a piece that's going to come out early next week on this, where I systematically look at restrictiveness over many decades. And it's a really interesting piece, and I'll definitely share it with you. The way I would look at it is, first of all, the Fed funds rate doesn't actually impact much in the economy. Okay, so even the big banks, they're borrowing, their deposit rates, what they're ultimately paying clients for deposits is negligible. It's like 5 basis points. Some regional banks are paying more. They're paying up to the Fed funds rate, but the vast majority of funding in the economy is not occurring at the Fed funds rate. So that's not the rate that I think matters. What I think matters is more the 5-year to 10-year parts of the nominal interest rate curve, treasury yields. And when I look at restrictive, there's a number of ways to do it. I like to look at the 10-year yield relative to nominal GDP. It's a tried and true way to look at it over history. And when you've had a really hot economy that you want to cool, in general, you would need the 10-year yield above nominal GDP. Okay, so in the 2007 cycle, before that fell apart there, obviously there were a lot of factors that dictated, what happened in that cycle. But the 10-year yield was above 5.25. And, ultimately that, when policy rates were roughly similar to where they are now, the 10-year yield was above 5.25, and it did ultimately hurt the economy. In the 2000, cycle, the dot-com cycle, policy rates were up at 6, and the 10-year yield was 6.75. Okay, so you had much higher, level relative to nominal GDP. Nominal GDP in the last 4 quarters has been about 5.87, give or take. Let's just say 6, and the 10-year yield is 4.4. So by this measure, policy's loose. Also, a way to look at the neutral rate estimate is it's really strange that the Fed has 2 models for this, and they only really talk about one. They have the Williams model. Obviously, Williams is the president of New York Fed and an influential member of the Fed. That model has never changed from the post-GFC period to now. And it still says the nominal the real level, inflation adjusted level is 0.5 or 0.6%. So it's never changed. Nothing in the economy has changed, from the GFC to COVID to now. I think that's a little bit harder to come to terms with. It seems the economy has changed. They have another model, which is the Lubick model from the Richmond Fed. Now, what I like about this model, I haven't gone, and tried to recreate the math of it. Okay, that's very complicated, a project. But what I like about this model is it's more flexible to the regimes and has gone up and down over most recent decades. So prior to the GFC, it was about 4.5% nominal. This is assuming a 2% inflation, and declined to roughly the same 2.5, 2.6 as the Williams model in the post-GFC period, and has since bounced back to about 4.25 nominal. Now, the interesting thing about that is that assumes 2% inflation. If inflation is sticky and trending at 3.5%, then your neutral rate is actually more like 5.25 or 5.5, give or take. And so in that context, even by the Fed funds focused metrics, it would say we're at neutral. We're not above, we're not well above or restrictive. We're basically just at neutral, which is not imposing restraint or stimulating the economy by their own metrics. So what I did was I looked at the 10-year relative to this Lubick model on both a 2% trending CPI and a 3% trending CPI, compared this over many cycles, and it shows you that policy is actually quite loose. It's tightened this cycle, but it's still loose. We're basically at 2011 levels of restrictiveness. We're nowhere near what was in place in the dot-com cycle. We're nowhere near what was in place leading up to 2007 or in the 90s. In neither of those are we anywhere near the level of restrictiveness. And so this lines up with what I had been thinking all along using my mental math, but it lines up. And I think this is a word of caution for the Fed in that they're not very restrictive, if at all.
So a lot of the commonality between those different frameworks of whether it's 10-year minus the Lubick model or 10-year minus GDP is it feels like the 10-year is lower than it should be. And I
Yes.
compared that with what's happening with the 2-year, 10-year curve has been inverted for almost 2 years now. And it doesn't make sense to me because there's no recession on the horizon right now. So what do you think is going on there? Is the 10-year artificially low? What do you think is driving that, if you agree with that? And is that why we're seeing so many mistakes being made in terms of understanding where we are in terms of this business cycle?
I do think that the 10-year, the messaging from the bond curve, the yield curve, is broken. And I think the Fed broke it in 2021. And, you have to remember that at this point, the economy was roaring, out of control, overheating. At the middle of 2021, nominal GDP was roughly 13%. And if we think that trend or potential GDP is 4 to 5%, well, then we're way overheating at that point in time. Inflation was picking up to roughly 6% pace by the middle of 2021. And yet the Fed was buying bonds every single month consistently in huge size. So at the end of March 2021, which we had a nice sell-off in the bond market as Biden's, fiscal package was enacted, the markets reacted, appropriately in that the curve steepened. And typically early in a cycle, the curve will bear steepen, meaning rates are moving up, but they're led by the back end of the curve. And the reason is because the Fed is on hold. They're not acting yet. So the front end is kind of stuck. And really the back end, does the job of reflecting the macro conditions. And in that whole year, the curve was bull flattening, meaning rates were moving lower and led by the 10-year moving lower. And I think a big reason for it is the Fed was saying, we're not going to have hikes, a material hiking cycle, and we're not starting until 2024, I believe they were saying, if I have that correct. As far back as 2021, they were saying we wouldn't hike until then, or end of 23 or 24 is when they thought they would start. And that it would be very shallow, 2.5%, 3% type of hiking cycle. And on top of it, they were buying 120 billion of bonds a month. They had another 80 or so to 100 of reinvestments from their portfolio. And then they changed the regulations, which encouraged the banks who were being flooded with reserves from all this QE to buy bonds. And obviously that was a major mistake for the banking sector. And so, what we had was approximately 300 billion of systematic buying that was not price sensitive. It was completely price insensitive. It was just buying every day consistently. And you had 10-year yields go from 175 in the end of March to 1.1 at a time when the economy was roaring ahead. So we started the hiking cycle, which obviously started in early 2022, with a curve that was way flatter, or much flatter than, typically warranted at that stage of the cycle. And obviously when the Fed is jacking up the front end of the curve bear flattens. And so in my opinion, the curve was too flat based on what the Fed had done, buying all this amount of QE. And it compressed, the traded rates of 5-year, 10-year, 30-year rates just way too low. We call it the term premium as a measure of the excess compensation an investor should demand for. Yep, there we go. We call it the term premium for the the demand that investors should require to own longer duration debt. And that is, as you can see, was still negative in 2021. It's only zero now. I think it artificially compressed this part of the curve, and as a result, everyone looks at the message from the curve and says the economy is going to fall apart. I actually think the inverted yield curve is stimulating the economy. It's what's keeping the economy afloat, and I'll explain why. In every hiking cycle, interest income goes up. There's obviously, two forces at play when they raise rates. Interest income goes up, but also interest expense goes up. And typically interest expense goes up more than interest income, and that slows the economy. In this context, everyone knows the story where people turned out their debt in 2020, 2021. where corporates also termed out their debt. So when we've jacked up the front end, anyone with a cash balance, anyone, including companies, including the corporate sector, is able to earn, 5.5% roughly in risk-free T-bills, and they can roll these forward, and they have for well over a year. And so, that interest income is doing exactly what you would expect. And then, the 10-year is artificially too low, and in my opinion, is not doing enough to restrain the housing market or other interest rate sensitive parts of the economy. And so it's stimulative. And we see this very, frequently, that whenever the 10-year moves down a material amount, like 50 basis points, the housing market responds. It responds positively. And you see, mortgage applications pick up. We see home prices pick up. We see transactions pick up. And so clearly, and we see the corporate sector increase their borrowing. They're not waiting for the maturity wall at the end of this year or next year. They'll take care of it now. And so everyone in the economy is telling us whenever we have these bond rallies, it's a gift. Let's take advantage of it.
Yeah.
And that tells you that, if a 4.25 10-year yield is a gift for borrowers, that it's too loose. It's too loose. So in my opinion, because of the curve, dynamic in 2021, this is why I think the Fed will have to hike, is that they've taken off the table anything that would involve the 10-year alone moving up. So their T policy is being tapered. And on top of it, QT is just bonds rolling off the balance sheet that are very, at their maturity.
Yeah, they're not fully selling them.
They're never been selling bonds.
Yeah.
And so if they were selling bonds, I believe that the term premium would be normal. We'd be a 5.5 or 6% 10-year. And then they could actually cut the front end a little bit to probably 4.5. But because of the fact that they've never figured this, either they haven't figured it out or they're terrified of the impact on banks, they've never managed this properly. As a result, they're going to have to hike to get the 10-year to the level that actually restricts the economy. They'll have to force it.
So basically, instead of directly bringing the long end up, they got to hike the front end up so much that it basically trickles into the long end further.
Yeah, there's lots of schools of thought on the long end. Obviously, the supply factor is enormous, the amount of debt that's being issued. And there's a lot of very smart people like, Andy Constant, who say the supply of debt will push the term premium, higher. And it could, that could be the way it plays out. In my opinion, it's a very slow moving story if it plays out that way, because it's not like last year where they're going to surprise us with an extra 200+ billion in supply. Pretty much the supply is well telegraphed at this point that it's large, but it's telegraphed. Everyone knows what it is. And so it's really just about these auctions being a little bit tougher to digest, investors demanding a little bit extra premium to take down these auctions. Maybe that gets us there on its own. That's the flip side argument to rate hikes, is that if the 10-year got there by market forces alone, I think they would avoid needing to hike. But so far, I'm skeptical.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back permissionless. We're going to be doing permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for permissionless. And because y'all are such faithful listeners, we've got, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
So look, I want to walk through a little thought experiment, because a lot of what we've talked about so far is basically, I think the people at the Fed are pretty smart. They're PhDs. They're probably smarter than me. That's for sure. I do believe like they have somewhat of a good understanding of what's occurring, but it's obvious they're doing the exact opposite of what should be done. Why do we think that's being done? Because if we just look at what's going on in the yield curve, is yes, there's more debt being issued on the long end, but they're really weighing as much as they possibly can, issuing on the front end, issuing bills at least to suck up the balances in the reverse repo. At the same time, we're seeing the taper of the QT coming in, which is very surprising to me that that's actually occurring, especially because there's already the standing repo facility established by the Fed, so that if there's any September 2019 issues, which is what caused the last time for QT to end, that's there and ready to take up that excess demand. So it doesn't really make sense to me. But if we start to look through this potential lens of, are they, potentially want to call it a bit of a cynical lens, a political lens, is there any sort of political forces you think at play that are driving these decisions to be made? Because it feels to me like this is almost, you look at what's being managed on the front end of the curve and the long end of the curve. Do you call that soft yield curve control possibly? Or what do you think are driving these dynamics? Because it doesn't make sense to me. And it doesn't make sense to you as well, I know.
I don't buy into the political arguments. And here's where I would push back on the political arguments. The fact is, if they're artificially, compressing the 10-year because the deficit is too large, well, there's no fiscal consolidation happening. So what does buying time do? It just makes the problem worse down the line. So I don't believe that that's what they're doing. My base case is they haven't figured out the things that we've talked about yet, that the 10-year is what matters, because they never talk about it. They never talk about the 10-year yield. They always talk about the Fed funds rate. And they never considered asset sales, despite many people saying they needed to. So my base case is they haven't figured it out yet, and hopefully they will soon. But there is a plausible alternative explanation, which is that they're worried about the banks and that they're buying time for the banks. Because we had SVB last year and it didn't turn out worse, as bad as feared. But at the same time, it did expose that banks own a ton of treasuries. They bought them at the Fed's direction and guidance. So the Fed is somewhat responsible for the plight of the banks in that.
Yeah. Because back in 2021, Powell was like, we're not going to hike rates anytime for the next 5 years or so. And he basically said, everybody buy duration.
And there was a regulatory change, which, people who are well-versed in the bond market are familiar with, which is the SLR exemption. That expired at the end of March 2021, literally the peak of yields for that year. And, that was something that basically allowed them, using their reserves that they were flooded with, to expand their lending to the real economy without having to account for the capital charges associated with that activity. And when that exemption expired, that meant that with the reserves that they had, they could either park them at the Fed or buy treasuries. They chose to buy treasuries because policy rates were zero at the time and 5-year and 10-year yields were over 1%. So they made the decision at the time based on that Fed regulation, which was, a temporary regulation, wasn't supposed to be there forever. But if you were going to do that and let that expire, you should have also expired QE at the same time, if you ask me. It's possible that they see this as a situation where let's give the banks some time to rebuild their equity, because after SVB, we didn't see the TARP style, like the way 2008 happened. All the banks raised capital. They raised some from the private sector where they could. They raised from the government in preferred shares where they couldn't. But they raised capital, which allowed them to continue lending and operating in the real economy. After last year happened, not all of them needed to raise capital, but nobody raised capital. Nobody came and said, we're raising capital to be able to expand our businesses. And frankly, lending is extraordinarily low despite the strength in the economy. So it's possible the Fed, with their very, tight insights into the banking sector, is saying we need to let them rebuild their equity organically through a period of time. And when they can handle it, we'll then finish the job or, whatever. And if that happens, then the banks are, not going to be under attack if bonds sell off, another 100 basis points or 200 basis points from here. That's my my optimistic view that the Fed has this all figured out in some grand plan. But they're certainly not communicating that. And I wouldn't, if that is their thought process, I wouldn't expect them to communicate they're worried about the banks, because then you create worries about the banks. So it's possible it's that.
We've talked a lot about the Fed, but I'd love to shift gears to the other side of the equation these days around the fiscal situation. And, I would be curious first as well, like, what do you think is, do you see deficit spending as being one of the key drivers, that it's keeping us from hitting that 2% inflation target as well?
I do believe that the fiscal spending has, shifted the economy to a level that we would not have gotten to. But at the same time, the marginal impact is very small right now. So the way that you look at it is not the first derivative, it's the second derivative, which we call the credit impulse. So let's just say lending was growing at 10% year over year. This is a credit impulse. Let's just use that as an example, and then we'll come to fiscal. But let's just say that the credit impulse in the economy was banks were lending at 10% year over year. And then next year, they lend at 5%. Even though that is still growing, it has a negative impact in that we've shifted down from what we had in the prior quarter, because GDP measures rate of change of the economy. So on the same basis, the fiscal spending, even though the budget deficit is large, at 7% of GDP, the impulse from 2021 till now has been negative. So I don't believe it's contributing, to the economy here. What I do think is, and I don't think it's crowding out, investments. As a look at, what companies are doing, they've been investing. Everyone's very bulled up on AI. They're spending a ton of money, CapEx, on AI. So far, it hasn't returned anything for investors in terms of profits. It's had nice shareholder returns, but it hasn't delivered profits yet. I do think it will. I'm not one of those guys who thinks it won't, but companies are spending. Companies are happy to do that. They're happy to issue debt to finance their spending. So I don't believe that the fiscal situation is such that it's crowding out anything. Where it is an issue is that I think in the event that we have a recession and inflation is still too high, the Fed won't be able to cut as much. And because we expended our fiscal bullets during a growth cycle, during the recovery, we may not have the bullets to support the economy when it weakens, right? Because automatically fiscal spending will go up just to lower tax receipts. Like go back to 2022, we had lower tax receipts than 2021 just due to the bear market in stocks. That leads to spending, actually being higher as a result. Borrowing more from the White House, the fiscal authorities. But that will happen naturally when the economy weakens. And again, if the Fed can't support the economy as much as they would like to, or if they do, it's a bad situation because it leads to inflation. You would hope fiscal could take the baton and do something, but I think that their bullets are kind of tied. And then on top of it, whether it's either candidate for president or the just general geopolitical environment, it looks to me like spending needs to go up, not down. Given the geopolitical dynamic, I think military spending is probably too low, probably needs to go up. They need to not only rebuild the stockpiles of ammunition that they've been, depleting and giving to Israel and Ukraine, but, they need to be prepared in case China makes a move on Taiwan. Let's hope it doesn't come to that. But, do you want the U.S. to be prepared to deal with that situation? I would say, military spending is only going to go up. And then on top of it, we have an aging population. So spending on things like Medicare is only going to continue to rise as a percentage of GDP. And then the big kahuna, as I call it, is Social Security, which anywhere in the next 5-6 years is going to turn into a deficit. And that will be a political nightmare given how many elderly people rely on it and poorer income brackets rely on it as an income source. It's politically infeasible that they allow this to happen. At some point, they're going to have to shore that up with some sort of, take it onto the federal balance sheet. It's not even on their budget, but it might become on budget. So to me, the spending is only going to go up, not down. And, it will become a problem. I just don't know that it's a problem today. But obviously, an interest expense is growing as rapidly as it is. It will become a problem.
How worried are you right now, the debt situation? Like, do you see a potential of a failed treasury auction in the next 3 years, or you think that's still further ahead?
No, and I think, look, you have every reason for the term premium in bonds to be substantially higher, the reasons we've discussed. You have persistent inflation for 4 years now, well above 3%. You have elevated deficits, 5 to 10% of GDP every year of the last 4 years. And for the reasons we just discussed, nobody sees that changing anytime soon. We have nominal GDP consistently over the last 4 quarters print 6%. You have every reason to see the 10-year at 5.5%. And so we don't see a shortage of buyers. I'm still skeptical that the buyers are going to continue to pay zero term premium to own this duration. I don't think that this is the right level, but so far we're seeing that there is demand. And if the economy weakens, there will always be demand for treasuries. I think, there's a number of, actors in the bond market that they're just regular buyers. More power to them. But like, for example, asset management firms, the BlackRocks, the PIMCOs, double lines, these guys, they charge clients, an asset management fee, a fee for managing assets. They don't get charged for performance. So they may view bonds as unappealing as I do, but they can't own zero. They can be underweight the benchmark, but they're still going to own a ton of these bonds. And if they just say, we're going to wait until bonds, inflation is solved 2 years from now or whatever, they'll lose their assets. So they can't afford to just do nothing either way. I think in 2022, they were very much like, we're doing nothing, but they have not been able to stay in that position since. And so they're buying bonds regularly, every sort of move up in yield they buy. You have pensions who have a very economic reason to buy, and they buy the long end of the curve, so it impacts there. And the reason is they have long-term liabilities.
They don't want the reinvestment risk of short end.
That's right. And also, their liabilities are long-term. They want to match it. But also the fact is they've benefited from both sides of their balance sheet benefiting from this environment. They're the big winners. Their asset portfolio is way up because equities are up and real estate's up. Their liabilities are down because interest rates have gone up. And so their funded status went from like 80, 85% to well over 100%. And so they're just consistently saying, we'll just slowly sell stocks to buy bonds, on a regular basis. And they're buying. I think we start to worry about the deficit in a bigger way when the bond market is selling off, even when the data doesn't tell it to sell off. Okay, so if we're getting weaker data and the bond market is just selling off, this is the flip side of what happened in 2021, where we had extremely hot data and the bond market rallied every day. If we have the flip side of this, where the bond market is just a no confidence vote by investors at the time when the dollar is getting sold, then you know that this is just a pure no confidence vote and they probably need to get the fiscal side in order. I don't think we're there, yet. But we'll see, we'll see in the next couple of years.
Maybe we should shift gears here to a bit more of a global perspective. I know we've been talking a bit about commodities, and in recent weeks, metals have been rallying. And I found it really interesting to see that oil has been either stagnating or kind of bleeding lower. What's your view on that? I know you have a perspective on how a lot of the commodity price action is being driven from China and Asian markets, but we'd love for you to unpack where you're at on that.
It's not entirely clear what China's doing. There's a few theories that I have, and this is another piece. Actually, it's coming out tomorrow on this. But there's a few theories. One is that, they own a ton of U.S. treasuries, right? And these bonds have taken a nasty hit in the last few years. They're not traders. They're buy and hold investors. They're parking their reserves, about $1 trillion in treasuries, and their reserves are about $3.5 trillion, I believe. And so, a lot of it is in treasuries. And so seeing how badly bonds can get hurt, which is a new thing for them, is maybe a sign that they need to diversify their reserves away from bonds. And frankly, like, they could be looking at the inflation and debt trajectory of the United States and saying, we need to diversify our reserves. And so they're buying things like gold, obviously. They're buying, industrial metals like copper, and they'll need these metals anyway, copper in particular, aluminum, palladium, all these, iron ore. they will need these for industrial purposes anyway. So from their perspective, maybe they're just saying, let's diversify our reserves into physical assets away from these bond markets, and have things that we'll need in stockpile for the eventuality when we need to use them. We don't need to go out and chase them in the market. I think what's interesting is like you said, oil has not kept up, and China really doesn't have a need to stockpile oil like they used to, because their next door neighbor, Russia, is their best friend. And so they can actually buy oil from Russia. They have direct access to get that on a regular basis. They can buy it in Chinese yuan, not just in US dollars. So they're able to buy that organically. So maybe they're more of a just-in-time process with oil than they are with some of these other commodities. And they're buying from Iran as well, about 1.5 million barrels a day, give or take. So it's possible that that's why oil hasn't kept up in this, or they do go through these stockpiling periods, and they're full on oil inventories, and when that works through, then they do another surge. I guess we'll find out. It's really hard to say. The other plausible argument for what they're doing is to say they saw what happened with Russia with the sanctions, and they want to move away from the US dollar system as much as they can. They can't entirely, move, because their current account surplus gives them dollars on a regular basis, but they really aren't growing their US reserves. So it's possible they're saying we need to move as much away from the US dollar, because if they do make a move on Taiwan, which nobody can really predict, they don't want to be as vulnerable as Russia was. One of the stories that has kind of gone under the radar the last few weeks is that the US announced that they're going to give what they confiscated from Russia to Ukraine to rebuild Ukraine. If you're China and you've been building these reserves for decades, you do not want that to happen. So it's possible it's this. Taiwan is a risk I've been worried about for a number of years. No one really knows when, if it happens. But that's a terrifying scenario if that's what they're doing.
Where does your perspective on inflation sit into commodities? Because I would imagine that if we're looking at this upside risk in inflation, that oil would be going higher. But it sounds like a lot of the price action in commodities right now is driven by geopolitical dynamics versus macro dynamics. Do you feel like people are just fading the reacceleration in inflation and aren't, we're not seeing that upside in oil? Or what do you think's going on there?
So oil, doesn't trade on expectations. It trades on supply demand. And, if we don't have a country like China rebuilding massive stockpiles, if the US is not rebuilding the SPR, then it comes down to demand and supply on a short-term basis. I do think oil is, at or near its bottom and has room to move up. In the last few trading sessions this week, we've seen nat gas explode higher. So it's very possible that oil is just, has some latent positioning that's, keeping it short. That flips at some point. We fly 5 or 10 barrels, $5 or $10 per barrel higher. I've tried to fade oil unsuccessfully, so full disclosure there. I think, commodities in general doing what they're doing is certainly a sign of inflation fears. And, when you see gold and silver doing what they were doing this earlier in the year before copper jumped in, and they started to pick up. And, these are the areas that you want to own if inflation is picking up, because, what's the other alternative? Tips have been a terrible deal in protecting against inflation. They really haven't done the job. We could theorize why. Bonds, you have to be short bonds, and not everyone has the stomach or the capacity to short, bonds or pay on swap. So then what's the other alternative is either long stocks, which are very expensive, and maybe you've already made money running them up to where they are, and you're just a little uncomfortable here. You have no choice. It's either gold or silver. And I think they're telling a message, because they did bottom and start moving higher in the December FOMC. And what I have been saying about the Fed, full disclosure, I hate criticizing the Fed. They're public servants. They're doing the best job they can. They're trying. It's not an easy job to manage a $30 trillion economy and dynamics that we haven't dealt with in 4 decades. But I have been critical of them because I viewed that move in December as irresponsibly dovish. And that's, in a nutshell, the environment you want to own precious metals. Irresponsibly dovish is when you want to own them. And so they're sending a message that policy is too loose, although the message is a little muddied, by what China's doing. But there is a message there from the metals as well.
So based on everything we've talked about, how are you actually taking action on these beliefs? I know you focus a lot on volatility. We haven't talked too much about equities, but you're saying that you think they're pretty expensive here, which I don't think too many people would argue with. Vol is it seems like the regime has just been selling vol. VIX is almost at 10 again. Starting to remind me of getting to the era where we saw Volkswagen kind of explode again once we got sub 10. How are you playing this, and what's your perspective for the rest of the year?
Yeah, I mean, a lot of people think that we're going to get a very quiet summer. I think, the macro uncertainties tell you that you may not want to buy vol, and that's fine because realized is low. This week, the equity market has gone nowhere. We haven't had a move above 20 basis points on the day. So understandably, vol is coming down due to that reason. But to me, it's either neutral or long vol. I would not want to be short vol given the uncertainties we have. In particular, I like equity vol and rate vol. I think FX is a little bit more pinned due to the divergence story not playing out yet. I think it will start to play out more over the course of the year, but it seems like anticipating the divergence has not been a profitable view in FX. It's probably the actual delivery of divergence where it'll become clear. And so as central banks, other than the Fed, start cutting, the ECB, is widely expected to cut in June. I think the Bank of Canada, after what they got, in inflation this week, they're ready to cut in June. The Bank of England kind of got thrown a wrinkle today with their inflation being a little too high. I don't think they should cut, but they talk about it. They want to cut. And so I think as these cuts start to get delivered, the dollar will, certainly appreciate. But I think it's a slow moving story, not a fast moving story. But equity vol, to me, is a very, very attractive buy. And if I'm wrong, I'll lose a little bit of theta, until I stop out of a trade, and then I'll wait for a new opportunity and do it again. It's a limited downside risk for me. But when I look at equities, they had the ultimate Goldilocks scenario, earlier this year, late last year, earlier this year, where you had really strong growth, and the Fed, who is saying not only are they not going to do anything about that, but they're eager to cut. And so you had a reaction function where if the economy weakened, the Fed would cut. If inflation softened, but the economy doesn't weaken, even better, the Fed will cut. And in either situation, they're not going to hike. They're just going to cut. And so you had this impulse from lower yields, which is obviously stopped now. You had, the expectation that no matter what, the Fed has your back, that asymmetric reaction function. And I just don't think we have that anymore. I think there is a significant expectation of earnings for the end of this year, and maybe we meet it. It's a lot. I think it's like, over 10% for the next 3 quarters. That seems a lot to expect from the equity market when I don't think, even if the economy weakens, the Fed is not cutting until they see probably 3 to 4 months of weaker data. And so you're looking at probably a dead quarter where earnings have to go negative, and then they cut. And then it takes time for that cut to work its way in the system to improve the earnings trajectory for stocks. So I think the reaction function from the Fed has shifted. It's not the same. They're not as quick to come in and cut. And rightfully so, given the setback they saw this year. They're going to be skeptical. Even if inflation softens, they'll be a little bit more skeptical than they were. So you don't have that. And then on the flip side, if inflation is sticky or even moves higher, I think the possibility of the Fed hiking is non-zero. And so that's a change there as well. And even if they don't hike, bond yields could go up from here, for whatever reason. The supply story growth is strong. So you have a lot more negatives to the equity market than you have positives, if you ask me. The best case scenario for the equity market is nominal GDP remains strong, inflation doesn't flare up, and the Fed says we'll just stay on hold. That's not a bad place for the market. I just don't know if they'll meet their earnings expectations, but we'll find out. So to me, it's own vol.
Do you do like a long straddle or something like that, where you own a call and a put and basically are directionally hedged, but looking for a Vega upside, that sort of thing?
I do a variety of different stuff. I own straddles, just straightforward straddles ahead of the event risk. And that's kind of, when there's big events on the horizon, I like that. The trade I have now is it's actually the same trade that I did when I talked to Jack on the Forward Guidance podcast.
Yeah.
I re-upped that trade when the VIX hit 12 handle, which is basically a 1x2 call spread where, I do it where I collect premium. And in the first month of the trade, it's like a long straddle. If this market, falls, 3 to 5%, I keep the entire premium I collected. If it rallies aggressively, I'll pick up a lot of delta and make money. I like that now. I don't know. We'll see if we still have vol this low when we're like looking at payrolls and FOMC meeting. And I probably would simplify to just straddles. But for now, I think market can go in either direction. I don't have high conviction on the direction. I do see an investor base that buys every single dip. That psychology has not changed. Again, I think policy's not tight. So I don't expect that to change in the near future. But I think vol is just too cheap, definitely to the situation.
It's risky and brave to get ahead of that dynamic. But yeah, really enjoyed our chat, Danny. Feel free to let the listeners know where they can read more about you.
Sure. I'm on Twitter, Danny Dayan 5. You can find me there and get my daily sarcastic comments that hopefully you find entertaining. For long form, recaps and reviews of the macro situation, as well as trade ideas, as well as, interesting insights. I have Macro Musings by Danny D. It's a Substack. You can find the link in my Twitter profile. And, I just started that a couple months ago to share, my views in a bigger picture format. Things like we just talked about, is policy restrictive or demographic analysis or volatility analysis that I didn't see, shared too much by people. And so it's been a nice, enjoyable experience sharing my views with everyone. And, we'll see how it goes, from here.
Cool. Awesome. Thanks again.
Thanks for having me.